In this video, I will be discussing with you very quickly uh, what I call the concept of cross capital flow and how it influences the wave, uh, the impulse wave, cross capital flow. Let me cross capital flow. This concept is going to really change the game for you if you can really pay close attention and understand what I will be discussing in this video. Cross capital flow and impulse wave. Some days ago, I did a video that talks about uh, how to do currency grouping, and which of course currency grouping is like a secret code for capital flow. It is important for you to know different groupings of the currencies. In case you have not seen that video, I'm going to quickly just put the different groups so that you will we can be on the same page. Group A is what we call high yield commodity currencies, and this include the AUD, the NZD, and the Canadian dollar. So the Australian dollar, the New Zealand dollar, and the Canadian dollar. If you really want to understand currency grouping, you might look for the video in this particular YouTube channel. On this YouTube channel, I've done the video. Look out for the video, and of course, you can listen to that probably after you have listened to this so that you can solidify your understanding of currency grouping. However, in this video, my focus is to uh, bring the discourse of cross capital flow. And this is very important because if you will be trading the wave, there is need for you to understand what can initiate the wave in the market. The market moves based on wave, and this wave will be initiated by what we call cross capital flow. If there is no cross capital flow, in fact, the market will not give you a direct wave that you want to see. I'm going to explain few things, and then I will now give you a practical example on the chart so that you can really uh, flow with what I'm trying to teach here now. Group B of this currency grouping are what we call the low yield safe haven currencies, and it include the Swiss franc, the Japanese yen JPY, of course the US dollar, and of course I in that video I put gold, although gold is a commodity, and of course it's very important that you understand that this is a safe haven as well. So but because of the focus of this particular video, I might just need to exclude gold. If you want to trade gold, you should understand, or let me even leave it. It can help somebody by the time you are listening to this video, and you are able to see that gold is a safe haven type of commodity. Now, the group C is what we call dollar aversion currency, and it includes the euro and the British pounds, GBP. Now, these are the three groupings that we have, and it's important for you to know the dynamics behind these high yield commodity currencies and low yield safe haven currency, and of course the dollar version. Listen to that video that I'm talking about. You might need to check it and check for it on this channel. uh, Capital flow secret code, currency grouping, I think that's the title of the video. Now in this video, what do I mean by cross capital flow? Now, in the forex market, capital is going to flow from one currency at a particular point in time to another currency. Now, if you are to select the currency pair that you are to trade, it is important for you to take note that you will only select the currency pair that ensure that as capital is flowing away from a particular currency, there is a flow of capital into the second currency. What am I talking about? Let me give you for example now. Suppose you want to trade CHF JPY. Now, at Potential Miners International, we have established that uh, what we trade, we focus on trading the wave. So wave is our friend and we follow the wave, and that's how we trade at Potential Miners International. Now, if you pick CHF JPY, you are expecting that this CHF JPY, regardless of the time frame that you want to trade, you are expecting that this CHF JPY should give you either an impulse wave to the upside or an impulse wave to the downside, depending on the trend of focus now. So now currency cross capital flow, what it means is that the fundamental in the market and the sentiment in the market should be that capital is flowing away from either CHF while capital is now flowing into JPY. It's very important that you know this, and of course if I have time at the end of this video, I might give you an hint of the gauge that we use to know how capital flow, although I might need to do a separate video to talk about that. But then I might give you hints on the gauges we use, because these things, it might be difficult for you to just know. How do I know that capital is flowing into CHF at a particular point in time? There are gauges we use, and of course if you know how to read those gauges for each of the currency pair, currency, is going to really help you. So back to my explanation. CHF JPY will only give you an impulse wave either to the upside or to the downside, provided that there is cross capital flow, which means that if capital at a particular point in time, let's say a particular week, if the fundamental in the market, if the stance of the economic or the geopolitical stance in the global market, the forex market, of course, is making capital flow into CHF. If you will pair CHF with JPY, it should be that sentiment or another global stance, or set of economic indicators, they are ensuring that capital is flowing away from JPY. So when this begin to happen, like I said, you will know based on the gauge that you will be reading. Are you getting me now? But it's important for you to know that if capital if there is no cross capital flow, taking a trade at a particular point in time might not give you the required. First, it's not going to give you the move you are looking for. Then second, it might not get to your desired target. This is very important now. So how do you now begin to pinpoint or to pick currency pairs? Suppose that you are just maybe you want to apply this to your trading system now, and of course you do not have the whole idea of how we trade at Potential Miners International. You can use this currency grouping as a guide to start with. What do I mean by that? Now, this group A, these are high yield commodity currencies. Now, there are four terms that you need to take note of in this discussion, and I'm going to go through them one after the other. These are key terms. Number one, you talk of risk on sentiment. You talk of risk of sentiment. Number three, you talk of risk on dollar aversion sentiment. Then number four, you talk of risk of dollar aversion sentiment. These key terms, they are very important in this discussion, because when you pick currency from group A, you must understand the likelihood of capital flowing into that currency or flowing out of that currency depending on the tone of risk in the market. Now, for instance, if there is a risk on, what that means is that investors globally, they are ready to put their money into investment. So they are ready to risk a level of their capital in the market. And this is because there is, what we call relatively fair, stability in the market. There is no tension, there is no unexpected policy shift. So investors are really moving their money. In fact, they are engaging in what we call carry trade. Now, if the risk sentiment in the market is risk on, now capital is going to be flowing largely into AUD, into NZD, and into CAD. In fact, currently, this is July 2025. We are in a zone where I can say that we are now in a risk-on environment. Of course, how do you know risk of environment? There are gauges you use too. And of course, I'm going to do a video for this so that I will discuss this separately. Now, but currently, there is risk on environment. We are in a risk on environment. The implication of that is that to a large extent, capital is going to be flowing into AUD, capital is going to be flowing into NZD, and capital will be flowing into CAD. This is very important now. Now, I want to give you an idea of how do you pick currencies so that you will ensure that you have cross capital flow, because that is what will guarantee that you have the required or the expected impulse wave. Now, when there is risk off now in a risk on environment, let me quickly say this, the likelihood that capital will be flowing away from the safe haven is very high. Is very, very high, because the safe haven currency assets, they are currencies that investors consider to be or they are economies that investors consider to be stable. In fact, in most cases, they have very low interest rates. So when there is panic in the global market, investors push their capital into these economies, into these currencies as safe haven. Now, when the sentiment of the market is now shifted in favor of investment now, which means we are in a risk on environment, the likelihood that capital will now be flowing out of the safe haven is very high. By implication, capital will now be flowing out of the CHF, which is the Swiss franc, the Japanese yen, of course, largely gold. Capital will be flowing away from this safe haven. Now, if you are to do currency, if you want to pair your currency now, it is very advisable that you just might need to just pick a currency from group B, then you pair it with a currency from group A, provided that you have idea of how to check the gauge, because there is a gauge that will show you how the capital is flowing and whether it's right about time you can position for a trade. So now let me quickly talk about risk off. Risk off, like I've explained partly, is when you have global tension. Maybe there is geopolitical tension, in terms of maybe there is war, in terms of maybe there is trade war, or there is natural disaster, or any form of unexpected shift that can affect economies across the globe, or some certain economies that are major, maybe like the US economy now. If that happen, investors will, there's going to be a trigger of panic in the global market, and because of that, capital will be flowing away from the high yield commodity currencies, which is in the group A, into the safe haven, which is the group B. Now, let me quickly explain risk on and risk off dollar aversion sentiment. This is when you have risk on but with a tone of dollar aversion. In other words, there is risk on, but there is an aversion of dollar. Maybe because of the performance of the US economy now. Now, dollar is king in the market. you cannot overrule or undermine the effect of dollar movement in the market. So if there is, even when there is risk on, there is likelihood or it is possible that there is dollar aversion. In fact, currently I said that we are in a bit of risk on now by the gauge and by what is happening in the global market as of July 2025. But currently, dollar aversion is still existing. So this is a possibility of the risk tone of the market. I might need to do a separate video for these key terms so that somebody can now have a better understanding of it. But now back to cross capital flow now. What I'm saying in essence is that now this group C, they are the dollar aversion currency. When there is dollar aversion, capital will be flowing away from US dollars, and there is likelihood that capital will now be flowing into euro and GBP, because to a large extent they behave as anti-dollar currency. So that is why I call them dollar aversion currency. Now, if you are to pair currencies, you might be focusing on group A pairing it with group B, or group C pairing it with group B. Let me say that again. You might need to, even if you don't have the gauge, you don't know how to use the gauge or the currency index. These are the gauges we use, currency index, and all these currencies, they have their index. So you can look for the index of each of these currency. There is a way we gauge it, and of course that is particular about the potential miners trading system. There is a way we gauge it, and we know when capital begin to flow into a particular currency, and when it's flowing away from a particular currency. Now, but what I'm saying is, even if you don't have idea of the gauge, you can just look at the currencies in the group A. These are high yield commodity currencies. You can now pair them with currencies in the group B. For instance, you can say you want to trade now, you now pick, instead of CHF JPY, you now pick AUD CHF. The implication of that is, suppose there is a risk off, suppose there is panic in the global financial market, capital will be flowing away from you. You will understand, it will be flowing away from AUD, while capital will now be flowing towards CHF as a safe haven. This cross capital flow is what will engineer the impulse wave that you are looking for in the market. It is very important, as capital is flowing away from AUD and capital is now flowing into CHF because of risk off environment that we are, then AUD CHF as a currency pair is going to give you a very clear impulse move to the upside or to the downside, depending on the volume. Are you getting it now? But then for you to really understand and have clarity, I'm going to show you an example. If you are in a risk on, capital will flow away from AUD. If you are in a risk on, it will flow into AUD. If you are in a risk off, capital will flow into CHF. If you are in a risk on, it will flow away from CHF. In most cases now, take note, in most cases. Are you getting it now? So when you pick currency from group A and you pair with currency from group B, there is likelihood for you to have a pair that will ensure that there is cross capital flow. That is if you don't know how to use the gauge. Okay, now having said this, let me just show you few examples so that you can understand what we are talking about. In fact, you can I'm going to give you an example. You see this particular let me go to Euro SZD. Okay, let me go to okay, AUD. I think I use this as an example. CHF. Now, I want you to look at this very closely now. This particular impulse wave looks nice. In fact, every forex trader would have loved to trade this particular impulse wave, this particular impulse wave, this particular impulse wave. Now, this particular impulse wave was engineered by cross capital flow, and this happened as a result of the tariff war between USA and China around March, April. This triggered panic in the global financial market, and there was a risk of sentiment in the market. So capital started flowing away from AUD. Capital was flowing away from AUD. You see now, AUD, capital was flowing away from AUD, and capital was now flowing into, capital was flowing away from AUD, and capital was now flowing into CHF. CHF. Because of this cross capital flow, you now have a nice impulse wave to the downside. This will happen again and again in the market, and if you can really understand this concept, you can begin to position your trade for a situation like this where you can now bank maximum profit for yourself. I don't know if you can take time to just reflect or just go back in retrospect, and if possible you can look for a way to pair these currencies across different groups so that you will see what I'm talking about. Even if you have not used the gauges or the index, you can still pair AUD, CHF, pair the high yield commodity currency with the safe haven currency and see impulse move. See this impulse move now. This impulse move is a result of cross capital flow. It will happen again and again. Can you see it? Now, you can just check and pair so that you understand what I'm saying. This is a result of cross capital flow depending on the direction. Can you see this big move now? Is as a result of cross capital flow. And this is what you want to leverage on and position for as a forex trader so that you can be making profit for yourself day in, day out. Now, I promise to show you gauges that you can use. These are the index for each of the currencies. Now, the most familiar one, or the one that you might be familiar with, is what we call dollar index, DXY, and it's US dollar currency index. Now, every currency has its index. If it's JPY has its index. It's called Japanese yen currency index. Every currency, especially the 8 major currencies, they have their index. So when you now position for when you check the index, there is a way you begin to evaluate the index. I'm not going to go into the detail of this in this video so that this video will not be too long. There's a way you begin to evaluate the index so that you can, of course, you will use market structure to evaluate the index to know how capital is now flowing in and out of each of the currency before you can now position for your trade. I want to believe that if you can really listen to this video and understand what I discuss here and you apply it to your trading system, first it will help you to pick the best currency pair that you will trade, and of course you will now begin to now take massive profit from the financial market as you apply this to your trading. Until I see you in the next video, I want you to stick to this YouTube channel. I would like that you will subscribe to the channel and turn on the notification bell so that you get the video. If I upload a new video, you will get it on time. And of course, most of the videos I upload is like I'm doing like series of the concept that you need to trade into profitability as a forex trader, and you might need to follow it one video per time. So if you turn on the notification bell, it's going to help you to get the updates on time so that you can follow the video as expected. Until I see you in the next video, thank you for listening. God bless you.